I'm Joanna Simpson here at Risk Minds International in London. Joining me now is Michiel Haasbrook, Chief Finance and Risk Officer at BIL Swiss. Thank you very much for joining me.
My pleasure.
And you've been speaking about operational resilience on stage. In your opinion, what are the most pressing operational risks that organisations face today?
I think that what stays is the risks that have always been there. So if we look at our data, then it's basically, it hasn't changed that much in the past, God knows what, 15 years. So manual errors, human errors, etc., they are still there and they're very hard to sort of get rid of. Then I think if we talk about emerging risks, they're probably most in the tech space. And I think that we've all been woken up, I think, by what happened earlier this year by CrowdStrike, and it sort of zooms in on the potential that something happens somewhere in the chain that you're actually completely unfamiliar with, but it still affects you. And I think particularly if you put that into risk management lingo, then it's the outsourcing risk around third and fourth and fifth party providers, etc. That's really hard to control and also sometimes really complicated to map out where your vulnerabilities in that space lie. So I think that is still one of the crucial risks. If we then talk about sort of other areas, it will always have something to do with the big risk drivers of the moment. So geopolitical risk, emerging tech risks, and if you combine them, they're sort of mainly manifested around cyber risk, also state-sponsored cyber risk, and particularly I think criminally oriented cyber risk. Those are sort of top of mind and top concerns at the moment.
As CFRO, how can you foster a culture of risk awareness among employees to better manage operational risks?
I think operational risk has always been pretty hard to explain. I actually started in operational risk about 17 years ago. When we started, it was sort of vague, but I think thankfully, due to all sorts of external events, it has become much more live. So I don't need to actually raise awareness around cyber risk and cyber security anymore, because people are pretty vigilant about it themselves. So when it comes to the areas where you do need to raise awareness, I think it's always a function of creating a culture where people understand the value of risk management, and that goes to us to demonstrate actually what the value contribution is to the organization. Then I think it's a reliance on simple tools that we have and repetition. Repetition always is sort of the best awareness raiser at all time. But I think particularly being able to talk around real events that happened and also showcase good approaches to risk management can be very helpful. So when we see, like earlier this year, we had this news about one of the large banks where it was hacked and lost about God knows how many tens of millions of customer data, etc. When such an event happens, I don't have to beg my board anymore to free up some budget to enhance our defenses. They understand it. So it's a combination of sort of explanation, real life events, and repetition through the use of the tools that we have.
And you're an expert in the Chinese financial sector. How does it differ from other regions in Asia, Europe, and America?
Yeah, I think the Chinese financial center and system is totally idiosyncratic. One of the main differences and variables that explains that is the predominance of state ownership in the sector. So Chinese banks will typically, the largest ones, and there are very, very few exceptions, they're all state-owned and they follow government policy. So that means that there is little diversification in business models, and they will probably all be exposed to certain types of risks. So when we talk about real estate sector crisis in China, all banks have a very significant exposure to that. So there's hardly little differentiation. But I think the biggest differentiating factor, like I said, is that state ownership. That also makes it easier to save a bank, to recapitalize a bank, to jump into a bank, and to ask and demand regulatory compliance. So in that sense, it's a fundamentally different system. Part of the banks can probably be better seen as fulfilling a policy role necessarily than a very market-oriented or commercial role.
And by contrast, what unique risks do you face working at a Swiss bank, and how do you manage them?
I think it is not necessarily the location, but more the bank type. But if you combine these two, you see a predominance, particularly in the Swiss market, of private banks, some wealth managers managing the assets of very wealthy people. That comes, of course, with a completely different risk type. So if I compare it to my previous experience, that was much more to corporate banking, I'm less concerned here about credit risk than I'm concerned about compliance risk, know your client, anti-money laundering. And then very often we see that it's not necessarily sort of having issues around money laundering or facilitating money laundering, but the need to have appropriate and adequate controls around it. So banks don't get fines because they facilitate money laundering. Banks get fines because they have inadequate controls around this. And this is something that's particularly, of course, because of the specific banking sector in Switzerland, a particular risk that you will also see in Switzerland. Now, if you go a little bit more into the particulars of Switzerland, I think the system stands out from a structural perspective in one way. I think the supervisor is a supervisor of a relatively small country, so only 8 million inhabitants, so the supervisor isn't very large, but the financial sector is comparatively large or disproportionately large to the country itself. And that requires a sort of an agile approach to regulation, and it also means that maybe you're not as invasive as we, for instance, see with the ECB regulated banks, but you also need to rely on, for instance, more external parties. So where you see that you have an on-site inspection with an ECB regulated bank, in Switzerland you see that the regulator relies much more on the external auditor to perform certain tasks. And that, of course, can also create a conflict of interest, because who pays for this external auditor? It's the bank themselves. So that is particularly, I think, a structural factor of Switzerland. And then we have one that is very topical at the moment. I think that it doesn't necessarily immediately translate into a risk, but the market is very dynamic, particularly because of course, the situation with Credit Suisse that was integrated into UBS. The situation with Credit Suisse led to lots of outflows of managed assets, particularly from Credit Suisse. And it also makes that there is at the moment quite a large number of staff looking for new employment in Switzerland. And at the same time, we're all trying to get our hands on that limited share of business. So it's very dynamic at the moment. I do not have yet a picture of to what specific risks that can translate, but it is probably a factor to watch also in sort of things like staff turnover, loss of corporate memory, etc., that will at some point manifest themselves.
Michiel Haasbrook, thank you very much for joining me.
My pleasure. Thank you.